Welcome to my YouTube channel, The Executive Outcomes. My name is Michael Mansaliova. I'll walk you through taxation audits, a comprehensive overview. When we talk about an audit, an audit can be looked at from the perspective of external audit and internal audit. When you come to external audit, an external audit can be described as an independent examination of the financial statements with the objective of expressing an opinion on the truth and fairness of those financial statements examined. Whereas for an internal audit, this is an internal appraisal of the systems and operations with the view of expressing or reporting on the efficiency, economy, and effectiveness of those systems and operations. In this regard, an external audit is carried out by persons external to the entity or organization, meaning they are not employees of the organization. For internal audit, these are carried out by people who are part of the management system. They are employees of the organization. Here we are to look at tax audit. So for the purpose of this presentation, we are going to run with the definition of a tax audit as follows. A tax audit is an official examination of an individual's or organization's financial information and activities to ensure compliance with tax laws and regulations. You see, in this particular case, we are looking at a taxpayer being audited, and what the auditors are looking for is issues to do with compliance with tax laws and applicable regulations. What is the purpose of this tax audit? Just to emphasize, the main objective of a tax audit is to verify the accuracy of reported income, deductions, and tax payment. You know very well that if you are talking about income tax, for instance, the basis of determining how much is a tax liability is the income that a particular entity has generated. So it is important that the basis of this computation of the tax is accurate. We also look at the fact that when you are computing the income tax, there are some deductible expenses. Now, you have to be careful as a tax auditor to ensure that only those allowable deductions have been actually deducted. If you don't pay attention to this particular area, you might end up working on a figure that is understated because it has considered expenses which are not deductible, for instance, or it has got the taxpayer reducing the value by what is not supposed to be deducted. Then also it is important to look at the tax payments. When it comes to tax payments, there are due dates to be observed. Where there is non-compliance in this particular regard, penalties and interest might be imposed on the ailing taxpayer. So that's why we need to be careful and consider these particular aspects so that we guarantee compliance. I want to also look at the types of tax audits. For the purpose of taxation, we have a number of audits that can be carried out as follows. One, we can look at the field audit. A field audit is conducted in person at the taxpayer's location, meaning officers from the Revenue Authority will visit the taxpayer's trading business and carry out an audit or carry out the audit procedures to collect audit evidence. We also have a desk audit. A desk audit is one that is conducted remotely from the taxpayer's location, often by reviewing submitted documents to the Revenue Authority, either physically or electronically. We also have a random audit. In this particular regard, a random audit is one that is carried out without specific cause, selected without specific cause, or selected without a specific observable pattern. That is known as a random audit. The taxpayers to be audited are selected randomly without a pattern. So every taxpayer is given an equal chance of being selected and included in this particular sample of taxpayers to be audited. We also have a cause audit. A cause audit is one that is triggered by suspicious or inconsistent information. In our dealing with the Revenue Authority, the Revenue Authority can be sensitive to the way we conduct ourselves, and these particular traits can actually give us out to the auditors from the Revenue Authority where they pick or they believe there is suspicion or there is enough evidence to, or there is enough the situation is good enough to warrant suspicion, or can actually be triggered by certain inconsistent information that can cause the auditors to become suspicious. In this particular case, the auditors from the Revenue Authority will be geared up to come and find out whether that which they are fearing is real or not real. They have to find evidence to believe otherwise. So they come and carry out an audit. We also have what is known as a criminal investigation. Okay, a criminal investigation involves potential tax fraud leading to criminal charges. So in criminal investigation is triggered by where the Revenue Authority suspects some fraud has taken place. Okay, some fraud has taken place. which leads to criminal charges. In this particular regard, normally the criminal investigation will be planned in such a way that audit evidence is collected in a manner which is suitable to enable it be in a position to be adduced as evidence in a court of law. So that is the number of tax audits that you can have. So now, having looked at these tax audits, the types of tax audits, let's look at what are the trigger points for a tax audit. What causes tax audit? The common triggers can be looked at as follows. One, this can be due to discrepancies between reported income and third-party data. Discrepancies between reported income and third-party data. So one of the audit procedures in collecting audit evidence is to get collaborative evidence from third parties. For instance, if you are looking at determining the bank balance as at a particular date, the client, the auditee, could have stated in the financial statement that at a particular date or as at that particular date, the bank balance was a certain amount. So what the auditor can do is to request or to use a bank letter. This is where the auditor gets permission from the client to get information, or indeed instructs the client to inform the bank, the client's bank, to indicate direct to the auditor as to what was the figure at the bank of the client's account at the time in question. So you might find that where the bank has reported a different figure from that given by the client, then this results into suspicion because of this discrepancy between the reported income and the third party, in this particular case, the bank. We also have another trigger point which can be seen in form of frequent errors or inconsistencies in returns. Periodically, taxpayers may be required to report to the Revenue Authority about their income and expenses and deductions which have been used to give a report of the tax liability. Now, if the Revenue Authority notices that there are frequent errors that you make when you are making returns, then the reliance on your returns reported might be reduced. So the auditor might figure out or try to figure out whether indeed what is contained in your returns is accurately determined or not. They might come over and carry out an audit. Thirdly, we have a situation that can trigger an audit in form of high deductions relative to income. When the Revenue Authority sees high deductions relative to income, it might be a situation where the client or the taxpayer is trying to hide income, so that the tax liability can be reduced, Because if you deduct high values from income, you are going to end up with lower income declared. And on lower income, if the rate is applied, it will result in lower taxes, reducing your tax liability. So this type of gimmick, which can be employed by a taxpayer, can amount to tax evasion. Okay, the tax evasion is a means by which a taxpayer reduces the tax liability by illegal means. This is a criminal act because there is a plan or there is an intention and then you actually carry it out. So it's criminal. And that can attract jail sentence or fine or both. The other trigger is in form of large financial transactions. Okay, large financial transactions. In a similar manner, a taxpayer might think of including large financial transactions, which could drastically reduce the income tax liability. Okay, let's look at it in this manner. Okay. If you are looking at a capital expenditure, a large capital expenditure, what will happen is that the taxpayer knows very well that certain qualifying capital expenditure can lead the taxpayer to claim capital allowances. And the capital allowances are a form of relief because the capital allowances claimed can reduce the taxable income. Okay, they can reduce it will make the taxpayer have a reduced tax liability. Now, if you purposely introduce large financial transaction, maybe of a capital nature, this will be of benefit to the taxpayer because it will reduce the tax liability because capital allowances can be claimed as a relief. So where this happens, the revenue authority might be suspicious and would like to find out whether this is a genuine transaction or not. There's also situations when the revenue authority is tipped by some informers or whistleblowers. Again, this can be the trigger point to verify the facts by way of carrying out an audit. We also look at the audit process. If you are a taxpayer, what do you expect the audit process to be like? What are your expectations? What should you look forward to? How do you think the audit team will carry out this audit? So I'm going to look at a number of elements that are most likely to be followed when an audit process is being carried out. As a process, it simply means that there are a number of interlinked activities following each other to move a process from one point to its conclusion. So these elements include the following. One, there is the initiation. Okay, there is the initiation. The tax authorities notify the taxpayer of the audit. So they will come and present to you a notification. This is important so that you prepare for their coming. You put your documents in order so that the auditors do not waste time. Everything should be at least in place. Most of the things should be in place. That's why you are notified. Okay. Then the auditor needs to plan. Okay. The auditor needs to plan. The taxpayer and auditor should agree on the audit scope and timing. Okay. So the planning will look at organizing the audit team, okay, who is going to carry out an audit, who is going to be part of that particular team, and also part of the planning process will involve the auditor discussing with the auditee, the auditor discussing with the auditee about the timing, so that you minimize the disruption on the auditee's flow of work. Then we also have to know that planning will also specify to what extent the audit will be carried out, what will be involved. So talking about the scope of the audit, okay? So it talks about maybe the time period, the interval of time from what period to what period, all that kind of thing will be part of the planning issues. Then comes the examination. Okay, what does the auditor do? The auditor reviews financial records. Okay, so documentary review. There is also looking at interviews, management and staff of the organization. The auditor can inspect assets. Okay, the auditor can also make some observations, get audit evidence through observation. The auditor can also get audit evidence through recomputation. What you have computed, the auditor can ask that they look at the documentation and recompute and compare what you found as a figure and what they have found. In case there are discrepancies, then a further investigation needs to be carried out. Okay. We also have findings. Okay, the next stage is findings. So once the examinations have been done using various techniques of obtaining audit evidence, you get the findings. Okay, so the auditor identifies discrepancies or areas of concern. Okay, through those techniques that have been employed, you get these particular findings. Normally what happens is that the auditor will present these findings or query you about these findings so that you can offer an explanation, okay, about that. Okay, you can offer an explanation about that. Okay, and that goes to the stage of resolution. Okay, the taxpayer may agree with findings and make necessary changes or dispute the findings. Okay, and, now when there is a dispute, there is a procedure that needs to be followed. Okay, where the taxpayer may appeal. Okay, may appeal to revenue authority. There are procedures that are followed so that the case can be heard. If the case is presented to them, it should be in form of written evidence supported by factual matters. Okay, it's supposed to be supported. Otherwise, it will be thrown out, okay, by the revenue authority. There should be adequate support in terms of documentation to refute your, to support your claim, rather. Okay, to refute what the ZRA has determined, the revenue authority has determined. So there is need to support that. So otherwise, you won't be entertained. So that is what relates to the audit process in brief. Then you need to be aware of the key documents for the purpose of the tax audit. These include income records such as bank statements, invoices, receipts, and sales records. The bank statements will give information or shed light on what type of payments have been made through the bank and what type of income you have received through the bank. For invoices, they will give evidence of what credit transactions have been entered into. And then for receipts, it shows you what receipts have been, what income has been received, and the receipts are an acknowledgement for payment, whereas an invoice is a demand for payment. We also have sales records because they have an effect on determining the revenue sales. Okay. We also have to look at expense records. Again, when you make a payment, you find that a receipt is given to you. Okay. When you make a payment, you find that a receipt is given to you, and for any purchases, an incoming invoice is given. Okay, you have an incoming invoice, as opposed for income, any income is outgoing invoice given. Okay, and for expense records, to nullify or to cancel out a figure, it can be seen by or evidenced by cancelled checks, okay, to show that indeed that amount was not received through the bank. So there should be evidence of cancelled check, for instance. Then other documents that are important are, of course, tax returns. These are reports that are filed to the Revenue Authority. Copies of filed returns, okay, will give some light about what has taken place or what you are claiming. Okay, and then also you have supporting documents like contracts, agreements, and legal documents. Okay, these support your certain assertions or support certain claims. Okay, so these are some of the list of key documents which are important in carrying out a tax audit. Now, when you are carrying out an audit, okay, that's why I started by explaining what an audit is, because there is a lot of misconception when it comes to an audit. Okay, some people think an audit is there principally to be used as a means to catch thieves or wrongdoers. It's not necessarily the case. What is important is to explain what an audit is, and as you explain what an audit is, you have to be clear about the rights and responsibilities of the taxpayers as it regards a tax audit. So let's look at some of these points I've raised. 1. Right to representation. The taxpayer can have a representative during the audit. Okay, the taxpayer can have a representative during the audit. So you don't need to be the taxpayer yourself. You can engage maybe the services of somebody who is competent in matters of tax to assist you, so that the Revenue Authority can get accurate information. Then also there's the right to appeal. As I've already mentioned, where there is disagreement with audit findings, the taxpayer can appeal to the determination by the Revenue Authority. Okay, as I've said, there is a procedure which needs to be followed for appeals procedures. Then we also have to look at the responsibility to cooperate. Okay, providing requested document information promptly. So the auditors will require that you cooperate. Okay, you cooperate because it saves them on time. You are not the only taxpayer they are supposed to look at. There are thousands other taxpayers whom they have to attend to. So by you cooperating, you are reducing the tax the time of an audit at your premises. So it's important that you cooperate. Then look at the statute of limitations. Audits typically cover the last 3 to 6 years. Okay, last 3 to 6 years. In this particular case, it is considered to be more patent or more recent to enable corrective actions to be meaningful. Okay, because if it takes too long, you might find that where it borders on criminal issues, the matter might not stand very well in court because of certain changes which would have taken place. Maybe the culprit would have, maybe for lack of better term, would have passed away, and other evidence would then be maybe watered down in terms of strength. So it's important to not take too long or to look at an audit which is so remote and so distant from the current times. So that's why we look at this statute of limitations. We also need to be aware of the penalties and consequences. For instance, penalties for underreporting income, for instance, that can attract fines. Okay, that can attract interest from the time the right tax was supposed to be due to the time you are paying, so the interest can accrue, and also can attract potential criminal charges where it is established that it was intentionally done. Then it can lead to a criminal charge and you can be prosecuted. There is also accuracy related penalties. Okay, so when you look at this particular area, we're saying that these penalties can be imposed for substantial understatements. Okay, so it's important that you report accurately because you might suffer such consequences. We also have civil fraud penalties. Okay, civil fraud penalties. Civil fraud penalties are normally imposed on unintentional fraud. Okay, meaning you never planned for that particular fraud, but it has happened. Okay, unintentional fraud, you never planned for it, then it has actually happened. As opposed to criminal fraud, it means that you planned for it and then you actually carried out the act. That would be criminal fraud. There's an intentional fraud, and unintentional fraud. Intentional fraud is criminal, and intentional fraud is civil. Okay, it results in a civil case. We also need to look at the fact that you might end up having criminal prosecutions, and these can end up with you being awarded to pay fines, or you being imprisoned, or both. So that is where you intentionally wanted to defraud the government or the sovereign state in the tax issues. So you make the government lose revenue, and then you are going to be prosecuted, and resulting in fines, imprisonment, or both. Now, what are the red flags for auditors? Okay, what are the red flags for auditors? Common red flags can be covered as follows, where you have excessive aggressive tax shelters. Okay, So the auditor will now start looking at why is this person trying to embark on this particular aggressive approach. We also have where you find a taxpayer holding offshore accounts and transactions. Again, that can be a fatal ground for somebody to do wrong things. There is also the consistent reporting losses. You know very well that when an entity reports a loss, then there is no profit, therefore there is no tax which is supposed to be paid on the loss. So when you are consistently reporting losses, it might begin to make the auditors think you are just trying to avoid paying tax. Then also frequent amendments to tax returns. It means that maybe you are not so competent, you might end up presenting information that is not correct because you are constantly amending tax returns. So the auditor might think of coming over and trying to find out what is going on to establish the truth. We also look at how can you avoid unnecessary tax audits. How can you avoid unnecessary tax audits? One is by way of maintaining accurate records. Therefore, you need to keep well-organized financial records. Also, you can seek professional advice so that you avoid presenting wrong reports. So you can consult with the tax experts to assist you with this so that you present accurate tax returns, for instance. Also, they need to use e-file tax returns. This e-file tax returns, because of the way it is structured, it will lead you or guide you to work out your income. It will guide you electronically how to slot in the deductions, and the calculations are automated. So it will lead to reduced errors. It will lead to reduced errors. Therefore, you might avoid tax audits in this particular manner. Okay. Then also report all income. Ensure all income sources are declared. Okay. Because the auditor has a way of uncovering hidden income. So please make sure that you report all income, or all income should be declared. That's some of the ways you can employ or it should be observed to avoid tax audits. So we come to an end of tax audit. Thank you for listening. Please remember to subscribe to my YouTube channel. We are going to look at tax investigation in the next presentation. I'm going to give you how an investigation relating to tax is carried out. So it's important that you understand these things so that when the auditors come, you are aware what they are looking for. Thank you for listening.